2022 regular meeting of the Retirement Plan Subcommittee to order. I hope everybody had a good weekend and a good holiday as well. Looking forward to taking some time over the next month or so with the families. So I guess we have a couple housekeeping items in order here. You know, I am just in terms of the appointment of chair for next year as well as the vice chair. I'll say I'm willing to take any nominations from the floor. I will, you know, happily, you know, consider, you know, being the chair for 2023. But if people have a really strong inclination or would like to be the chair, I would happily relinquish my duties. And then we could talk about vice chair as well. Is there any conversation anybody would like to put their name in? I know we have kind of a short group here. Actually, along the side we've got Brian, Lacey, Tom, Tyler, Amber, Todd. I don't know, I'll open it up to the group and see if there's anybody who would like to step in either role, really. I know Sean Askham, I believe, is the vice chair right now, if I'm not mistaken, Melissa, and he's not on right now, but that's not to say that, you know, he can you know, just be a regular board member as well. So I'll open it up.
I think we can just keep it the same. I don't see any reason to change anything. 4 times a year.
All right, I will. We'll keep it the way it is for 2023. And honestly, I should have known that this was coming. Next year, we'll probably give people a little bit more time to think about it. I don't know how much past 2023 I will be the chair, but I'm happy to do it this year. So. And then in terms of vice chair, we'll keep Sean Askham, or, you know, I guess just for decorum, Lisa, do I have to call for a vote for that or a motion?
Question for Melissa. Generally, ad hoc committees by the Board of Selectmen, which this is effectively one, are for 2 years. Does he need to call a motion in the coterminous with the terms of the Board of Selectmen? Does this need to be done? If so, we could do a quick motion.
I don't think so. I think the MOU between the 3 boards on this committee says that you'll select a chair and vice chair annually.
Okay. So then you would need a motion, Derek.
Okay, I'll take a motion from the floor to.
I so move.
Thank you, Bert. Do I hear a second?
Sure, I'll second that.
Thanks, Todd. Any discussion? Any discussion? Hearing none. All those in favor, aye, say aye.
Aye.
Aye. Those opposed? Okay, the motion passes. Thank you, everybody. I look forward to another fun year.
Derek.
Thank you, Bert. I appreciate it. So we'll move on to the minutes. Does anybody have any questions or corrections, comments on the minutes for September 6th? If not, we can go ahead and approve those as written. And then, you know, before we, you know, move the meeting to Chris and Tyler, I think it's important. This came up, I think it was at our, we've had quite a few Board of Finance meetings. I think it was mid-November that we talked about the results of the Milliman experiential study. And I just wanted to, you know, it having been recommended by this subcommittee to do the experiential study, I thought it was important to let people know that Milliman came and talked to the Board of Finance. And it was really interesting. There's actually a deck that I think would be it would be interesting for the group to at least review, just, you know, for their own benefit. But the end of the day, taking in all the different assumptions that go into you know, calculations for what people owe and the town owes, it came out that the town actually is benefiting by $100,000 per year because of the study. And I thought that was a really good outcome, and I appreciate people's conversation around it. And like I said, I think it would be great, and I could do it. I'll send around the Milliman deck for the group just to review and see how they came up with those calculations. So with that, I will turn it over to Chris for the pension plan and OPEB performance.
Great. Thanks, Mr. Chairman, and good morning, folks. Echoing your comments, trust everybody's well and things are in good order. We'll pull up the deck momentarily that Melissa had forwarded around and hit some of the highlights. Maybe what I'd offer up just as a quick comment or two from a larger context perspective for the group. I think, as you all know, it's been a particularly interesting year in the capital markets. And if you had the occasion to look at some of the details, as you'll note, certainly through September, markets continue to operate in a very challenged fashion for both equity and fixed income, and fairly meaningful double-digit negative returns for both categories, and really a bit of a no places to hide type mentality, right? And centered on, again, continually, I suppose, the Fed's actions around interest rates, the pace and magnitude of their austerity campaign has certainly created a lot of havoc in markets. What you have seen, and we'll tease some of this out in the data, is the fourth quarter, interesting, has been a lot better in capital markets. Just a couple numbers you don't have in your deck, but bonds are up 3.7% through Friday night, fourth quarter. The S&P's up 14%. Small company stocks in the U.S. are up about the same. And international stocks actually are up close to 17% fourth quarter to date. Some of that relief centers on, as you've probably read, right, this handicapping that markets continued to do about how aggressive the Fed needs to be, where terminal interest rates will end up, and a sense, right, that they're starting to get their arms around the inflation situation a little bit. And as you can appreciate, right, I think that comfort level that investors have garnered more recently from some of the Fed comments and actions has obviously made its way into capital market returns. And it certainly, I think we previewed this at our last meeting, and we'll show you the outright detail next meeting. Our capital market assumptions that we're just in the very final stages of updating for 2023 and beyond, when we do your portfolio construction affirmation next quarter, return assumptions are up pretty dramatically, right? So as painful as 2022 has been, when you look forward, given what interest rates have done, and they are obviously materially higher, and where you look where equity valuations are as well, you could have the makings, we think, for a pretty good outcomes here on a go-forward basis. Again, it all centers on when that kind of relief more consistently starts, and it's what happens with the economy, right? And I think we continue to be in this period where folks are more than not thinking we'll have a recession next year. It's maybe a mild one, but a recession nonetheless. And that's obviously the fulcrum on where markets will maybe start to get their legs more consistently. So we do think things will continue to be volatile here for the near term, as folks try to get their arms around a couple of these factors. So that's big, admittedly, very big picture. Let me, if no one objects here, Melissa, I'm going to try to, let's see if I can do it here, share the deck. Give me a second. Can folks see that okay?
Yeah, thanks. I think if you can, actually, if you move both your border sides to the side there, and then maybe expand it a little bit.
I was going to go to, let me see here.
Oh yeah, there we go.
Is that better for folks?
Yeah, that's great.
Okay, well, good. Let's and again, stop me along the way. Of course, as always, this is a conversation more than a presentation. But let me just come to a couple of big things. Just a general update, because Tyler and I will be slapped on the wrist if we don't. But the firm continues to put a lot of fresh collateral out on our website, and certainly would encourage you to do that. You see some of that information at the top half of the page here. And then we do continue to have aspirations to grow thoughtfully, and have been hiring new folks in anticipation of that growth. You see there on the bottom of the page. So kind of all systems go, if you will, from an organizational standpoint. So here is, I jumped ahead here. We'll show you the September numbers, absolutely. But just to give you a little more topical color here, you see capital markets for October. And again, here, you'll remember the chart here on the top half of the page, the vertical bars are the year-to-date numbers indicated, and then the encircled numbers are just the month of October. And you do see there, right, still kind of a little bit of a mixed quarter. Fixed income, or month rather, excuse me, fixed income down a bit still, although you do see a bit of relief on the equity front there in certain categories, particularly the U.S. markets. And that persisted into November, and did so in a much more dramatic way. So both fixed income and equity returns, as I mentioned, had very strong Novembers, and probably hopeful that that'll continue into the end of the calendar year. Just from a performance perspective, quickly, the plans, we'll start with the town plan. Upper left-hand corner of the page is the dashboard. You see the numbers there, about in line, if you will, for the month of October. Running about in line as well, right, over the intermediate and longer haul as well. And you'll remember the kind of the mantra we've had with respect to the portfolio, the allocation, and the collection of active managers that you have, right, is this premise that over time, markets go up more than they go down. And the managers in the program, in many ways, if you look at their statistical outcomes over time, tend to participate pretty dramatically in markets that are going up. And that's our intention, right? So we do think as markets begin to settle down here and improve, hopefully, we'll start to see, as we've seen in the past, those incremental returns north of the benchmarks persist more consistently, excuse me. And again, numbers that you don't have on the page, but I just wanted to share quickly. In the month of November alone, MetWest, excuse me, your fixed income manager, one of them is up 4%. MetWest is up almost 6% in the month of November alone. Your equity managers, depending on the category, up anywhere from 5.5% to up almost 15%. So pretty good returns there, and incremental returns, I think, over the broad markets when everything reconciles out. So, just a foreshadowing what we think will hold out here if markets cooperate over the next 3.5 weeks or so. So that's town plan, 24.8 million at the end of October. I previewed November was a pretty good month. You see here what the planned balances were at the end of the month. So a nice increase, right? $27.6 million. At the bottom of the page, you do see there, and we've been working with Amy with the town contributions and principals. So there's a little bit of an outside cash position here that is being cured as we speak, actually. So we'll invest that down and leave a little bit of liquidity for the next couple of months. But that's just a byproduct of the timing of the town contributions. It's certainly nothing conscious beyond that. So I think from an allocation standpoint, we're in pretty good working order. The only thing I'd mention from a manager roster perspective, just to highlight for the committee, and this will carry through, of course, for the Board of Ed and the police plan as well. BlackRock Strategic Income, one of your fixed income managers, you see them at about a third of the way down the exhibit. We did elevate that strategy very recently to discuss. You'll remember discuss in our research framework is indicative of there being a situation at the firm or with the strategy that we think requires a little bit of an elevated monitoring status, but it is not likely over time to impede the strategy's ability to earn the type of returns we expect. So the detail there for those interested is one of the portfolio managers on the team, a gentleman named Bob Miller, who's been on the strategy for quite some time now, announced his retirement next March of 2023. BlackRock is pretty thoughtful around those retirements. They have had other PMs, kind of lurking in the background and have been named onto the strategy, very experienced in the way things are run there. And the leader of that strategy, a gentleman named Rick Reeder, who I think we've mentioned in the past to the group, and the architect really of the strategy in many ways, continues to be fully engaged in and lead those efforts. So I think the strategy will be just fine, but I didn't want to elevate the discuss item for you just as a matter of record. The rest of the roster there has our maintained designations and are in good working order. Board of Ed, right? Similar numbers, upper left-hand corner of the page, about in line for the month of October and running longer term, right? Kind of consistent as you would expect, right? With town plan, given they share allocations by and large and manager rosters. So upper right-hand corner of the page at the end of the month, 26.4 million. And then again, a nice pickup you see here through November at 28 million and change. And similarly, allocations that are relatively close to target. So we don't have any recommendations for the committee this morning on reworking the portfolio as we come into year end. And then let me just do it. I'll kind of pause here momentarily. Police plan, same type of metrics as you've seen for the other two. Again, upper left-hand corner of the pie chart here. And you see the police invested asset total in the upper right-hand corner, the month of October at 18.6 million. And then again, a nice pickup like the other two plans, given how productive November was in the capital markets. So 20 million and change for the police plan. And again, similarly working with Amy just on contributions in with principal and getting a little bit of that money to work. You see in the very upper right-hand corner of the exhibit there. What at this particular point in time is an outsized cash position, but that's again being rectified in real time here and getting put to work. So that is the three pension plans. Before we segue over to some other material, any questions from the group, big picture markets and what's going on, or particular to the three pension plans?
Chris, I just had a quick question. And, the numbers look big, to the tune of basically down 20% or so across the plans, roughly. And a nice little bounce back in November, as I think your message received there. I'm just curious, did it just so happen that we were, grouping a bad 12 months? In other words, did October really underperform, and then November just kind of moved the needle back to a normal place, notwithstanding just the disruption in capital markets across the board? But I just, for the benefit of anybody who wanted to watch this meeting, where do you think the bulk of the loss comes from?
Yeah,
any particular month or event?
Yeah, I think, Derek, if you looked, right, if you peeled back a little bit, so first off, to answer your particular question on the front end there, you will see, right, the month of October itself for the plans was about in line with the broad markets. You see the 2.8 number there, if you can make it out, and similar numbers for the other two, and kind of a stabilizing relative performance track record, I think, over the last quarter or two. I think where we saw the biggest dislocation relative to the broad markets was in that first quarter of this calendar year, right? When we really had, obviously the war in Europe, I think, was not anything that investors and managers really anticipated. And I think that obviously caught folks a little bit by surprise. And I think if you were to do the arithmetic is where a good deal of the relative shortfall was. Since then, I think that the managers, by and large, right, have kind of recalibrated their portfolios and readjusted them to what is, pre and post onset of the war, very different, right, in investing environments. So I do think you've got an element of relative stability there. And you see a little bit of that Look at the fiscal year to date number, right, for the police plan as an example there, right? So since the beginning of July, right, running about in line through the end of October. But you do see a little bit of a shortfall. And for example, the year to date number, what is that, 40 basis points or something. So it was packed, I think, Derek, to your question, in the front end of the year. And it's been stabilizing a little bit more recently, if that makes sense.
Yeah, it does. I appreciate that. And then just a follow up on the, kind of the 2 and 10 year treasuries. They've been inverted for a while now, and it, not that maybe in the past it seems like people are ignoring that. That the 2 year is 80 basis points higher than the 10 year. It's actually widening instead of narrowing. And I just didn't know if you had an opinion on whether that really should even be looked at, or what that necessarily means for, kind of first quarter.
Yeah, it's a good question, right? So, I think, right, your intuition there is spot on, right? Because I think initially most investors think of an inverted yield curve and they immediately jump to prospects for a recession. Right, there's a fairly consistent link between inverted yield curves and economic slowdowns. And as mentioned earlier, right, I do think that most investors and pundits think that we have a mild recession forthcoming in the first half of 2023, for example. But the other thing, the dynamic that's kind of odd, right, is that what we don't have as good a vision on, to your point as to why maybe investors aren't quite as concerned with the degree of inversion, is we have certainly had, and let me see if I can find it here because it's a pretty impactful visual. Bear with me as I, here we go. So look in the upper right-hand corner of the page here. We've highlighted for you. Look at the pace, the slope, and the trajectory of the current Fed hike campaign versus previous ones. And I think investors are trying to still make sense of that as well, right? And certainly the markets with that inversion are indicating, right, that they think when all is said and done that the Fed is going to get their arms around inflation ultimately. And that's why we've got the inversion that we do. So there's some informational context, we think, to the inverted yield curve, but it does come right with a little bit of, I guess, unique characteristics, again, because of just this campaign is so unique and particular. And again, I think you see the visual impact of it here. So we're in the camp, to be honest, that we do have an economic slowdown as well. I think that to a large extent that's already been handicapped into markets and expectations, but hard pressed to think that the Fed does this with interest rates, right? And that starts to impact a little bit the broader economic backdrop. You see that. Look at PMI data down here in the lower right-hand corner of the page. You see it beginning to soften back towards that 50 threshold, which you'll remember is that barrier for a contraction versus expansion. And then moreover, look over here, look at leading economic indicators as well. I think we've shown you this data in the past, you'll remember. And we do have now, right, those have flashed negative. That index has flashed negative more recently, and is recently in history, when we've had these downdrafts, as you see here, right, that has coincided with an economic slowdown. So the jury, of course, is still out on what happens, but certainly there is some additional data, right, a contextual data that would suggest maybe a slowdown is coming. Hopefully, Derek,
thank you for that.
Hopefully that helped a little bit. The only other thing quickly, just before we depart to some of the other collaterals, so just so folks have it, right, the OPEB has a slightly different allocation. You'll remember we do have the indexing mantra there currently, and a decent month of October you see in the upper left-hand corner of the page, but numbers as you would expect, right, that essentially mimic the broad markets. That's a little bit by design, right? Because we're all indexed, and you see, what is it, $19.2 million at the end of October, and the uptake as well for the collection of ETFs that are being used for the OPEB. And a little north of $20 million. Was it $20.5 million for OPEB invested balances at the end of the month of November? So kind of that same general trend that you would expect, I think, that you saw with the pension plans. So those are quick updates on markets and the portfolios. The two other things quickly, this may dovetail a little bit, Derek, with your introduction on some of the Milliman information. You'll remember we just catalog periodically generic updates for you. And in this case, for this quarter, a couple of data points from the statewide information. And I know that this always comes with a little bit of lag, depending on where we are in the actuarial valuation cycle, but just capturing data from the Milliman report that we had ready access to. So funded ratios, return assumptions for the three plans. And that doesn't mean necessarily anything in a vacuum, right? But just to draw that into what we're seeing statewide. So you've got that perspective. This is a survey that Hooker and Holcomb did recently, just to highlight where return assumptions have gone statewide. And I think, as everyone knows, right, because we've talked about it ad nauseum, and I'm sure Milliman has as well, this entire chart here, right, has kind of dragged off to the left, as we all know, right, because peers like yourselves, peer committees, have been struggling with that same notion of what are reasonably expected return assumptions on a go-forward basis for balanced total return portfolios by and large. And those numbers have obviously gone down through time. So you do see there 6.5% is the statewide average, no surprise, similar to what you've got with the town plan. So nothing directionally really to indicate anything there, other than that your expectations and assumptions in many ways mirror what your peer communities around the state are doing. And just on a funded status ratio standpoint, some of that same data from the same study, and you see there, funded status, it mixes and matches a little bit, but you do see there a bit of improvement more recently. And that'll ebb and flow, right? I suspect that number, if you do surveys in the most recent a time frame, given what's gone on, for example, in 2022 to date, right? Those numbers might soften up a bit when the data comes in. But again, nothing actionable for the committee, but just perspective, so you've got it.
It's funny, Chris, because last year at this time, we'd be, still maybe talking about there might be some in the camp of even lowering the return expectations even more. And then kind of given what's happened this year, did anybody across the state actually, move to, a higher return as opposed to lower?
Yeah, great point. Actually, Gary, I'm glad you asked that question, because that's a great point. So we have not seen that, right? So to the idea, and it's interesting, right? Because I'll tell you, when we run your assumptions for you and we share that data with you at our next meeting, our capital market assumptions, I think Milliman's are as well, when I've spoken to our colleagues there, are likely to go up year over year, right? Because again, right, interest rates are meaningfully higher for fixed income investing, and the valuation dislocations we've seen in equities would suggest maybe higher returns as well. So Derek, to your point, right, I don't think anyone that we work with has had the courage to increase their return assumption, but it does it does alleviate the pressure, right, to what you folks have been hearing, right, year after year after year after year, is you need to lower your return assumption. And speaking to Milliman, I don't know if they mentioned this when they met with your Board of Finance, but they've told us the same. Their message is there's no reason to have to reduce return assumptions, certainly with the most current round of data. And we would be, in that same camp, because I think you're right on a go forward basis. And we'll show you that detail explicitly next quarter. But the return assumptions for capital markets have moved higher, which I guess is a small relief, right, from what has been an otherwise painful 2022.
Yeah.
So that is quickly a take through the governance collateral, and here's some OPEB trends as well, just for the record. There, you see kind of similar return assumption. Funded statuses, as you know, for OPEB plans are a little bit nebulous. They're kind of all over the map because some people, like the town of Simsbury, have gotten way in front of that and funded it and have it up and running. Many of your peer communities around the state have created trusts for a host of reasons, have not funded them very well, and others have. So it's a more variable return, a data set, if you would. So I wouldn't read too much into that just yet. I think as this data begins to season and mature, it'll be a bit more useful. I am going to for the record, you do have all the September data in the booklet. I think we've already kind of previewed, right, and highlighted directionally what's going on through September. My inclination is, in the interest of time, I know we've got Tyler needs to come on and do his update, and I know we also have on the agenda the ESG DEI work that we had done for you, and we want to share some of that detail with you as well. So I am Mr. Chairman. I'm going to go back up here to the top if no one objects. I just trying to remember. Oh, sorry. Oh, we do have, well, again, why don't I do this? If there's no objection, do you want me to do the ESG update now, and then we can have Tyler do his update? Does that make better sense?
Yeah, that's perfect.
All right, let me just scroll. I'm sorry for all this scrolling, folks. Let me just get, I think we put it, Melissa, in the very back, right?
I think I put it, yes, right after that.
Yeah, right after Tyler's details here. Give me 2 seconds, folks, just so I don't run.
It is bookmarked if you want to pull your bookmark.
Oh, I'm sorry. Yeah, you're right. That would have been the better way to do it.
That's all right.
So maybe we revisit quickly just with the group, right? We at the very highest level, there's lots of inquiry and discussion in the marketplace about ESG, about DEI, trends in the industry. What are investment managers doing about it? What should we be doing about it as a committee, if anything? Is it just an awareness? Is there anything actionable? How far do we want to take this? The frustrating answer for committees like yourselves is that there really isn't any rhyme or reason just yet to what folks are doing with these reviews and with this data, right? So while the industry at the highest level, the investment industry, is beginning to think more consciously about inserting some of these metrics into their evaluations when they're looking at investment opportunities, and using that detail, right, to build, what they think are portfolios with better return potential and more thoughtful return potential. It's very much in flux. I don't think that there are hard and fast answers or honestly, to confess, even perfect guideposts for folks like yourself on how to treat this. What I would say is that the town and your committee is certainly being very, very thoughtful and proactive about it. And a lot of our clients are doing the same. Many are not, and many have not even put this anywhere near an agenda just yet. So it's very much kind of a topic that is in development, and I suspect it'll be a fairly long and windy pathway to, where we may end up with it and how you might want to use it in the context of your investment portfolios. So as a reminder, what we do here for you, we took the roster of mutual funds. This is for the pension plan, of course, as you can see, and we have developed a framework. You see in the left-hand banner there, just that's relatively straightforward, I suppose, in terms of integration. Kind of the values associated with the effort, if you will, and then using so-called impact investing to express views here. And I think that the takeaway for this page for the committee, hopefully, I spoke actually to the chair of our mission aligned investment committee on Friday and shared this detail with her, just to get a little bit more color. And I think the general takeaway, hopefully, for the committee is that most of your managers, to some degree, right, are integrating some aspect of ESG into their investment, in their portfolio construction and the research efforts, right? In many cases, it starts with being signatories to some of the things like the PRI data and the like, and you see there a pretty consistent take up on that from your managers. Using third-party data to try to identify issues and what should be relevant in terms of consideration, being mindful from a research perspective of integrating some of this. And it kind of carries down, I think, through the entirety of the exhibit there. So again, there's no score to be had. There's no unfortunate definitive right or wrong answer to be had. Right, but I would leave you with, the conclusion I drew with the chair, our committee, was that, by and large, the managers that the town is using are mindful of ESG, are kind of considering it in their investment processes, and I think as things continue to develop and evolve, we'll continue to keep tabs on this data. And I would suspect over time, right, the integration and the consistency as some of the marks here will increase even more so. So that I just wanted, that's kind of the outcome there, just to warehouse that momentarily, and we can come back to it for sure. And what we also did for you for the manager group, is we do reach out on the DEI front and where we can try to collect as much data around things like diversity of ownership and the investment teams and the like. And as you can see here, right, again, the industry unfortunately is not perfectly uniform. Some just won't provide that data. You do see Vanguard there being an example. Some say they legally can't do it because they operate in certain jurisdictions where they're not allowed to provide that level of detail. So again, it's admittedly, right, a little bit of an incomplete data set, but it's what we've got to deal with right now, again, given how nascent the issue is. I think over time, we'll get more and more detail and perspective here. So I take these two exhibits together, and I think in mass that they represent, right, that your managers, as a general rule of thumb, are aware of the issue, are beginning to integrate it into their investment processes. And I think it is, right, something that probably over time has some endurance just industry-wide in terms of ESG being a kind of a conscious part of the way that managers invest moving forward. So again, I know that this isn't maybe taken to the level for the committee, right? There isn't anything actionable per se. Where I would leave you with is we've done this study for a couple of your peer communities around the state, and the data is pretty similar, if not identical. So you've got that level of context. And then the only other thing to answer, maybe front run a question you might have, at least across my practice, and I think more broadly across our Connecticut practice, I don't know of any committees like yourselves that have gone to the level of actually consciously trying to integrate for example, ESG investment, right, and labeled as such into their investment rosters, right? I think that would be maybe a next step that people would consider. I think most, though, are saying, hey, listen, we're aware of the issue. We understand it. We're going to talk about it through time. We know it's very evolving and dynamic. And we think our managers, we've cataloged them, and we think by and large, they're doing a decent job on their side, bringing some of these issues to the forefront. And for the time being, we're comfortable with that, being an outcome and not taking it to the level just yet, for example, of putting a socially conscious domestic equity manager into the roster itself. And that, as you all know, comes with a whole host of complexities as well, right? Because not only are you imposing a committee's view on things, right, which obviously has to come with some discussion and analysis, but you're going through the whole issue, right, of are you return's going to be up to task, and we have other fiduciary responsibilities beyond just being ESG aware that we have to integrate into the analysis. So that was very long-winded, I know, but I think I would leave it with that. My suggestion to the committee is over time, maybe every other quarter, something like that, we update this analysis and provide it for the record, and pledge to keep you posted as well to developments with the what's the word for it, right? The category, the trends, if you will, and keep you posted as well. So that, Mr. Chairman, is what we've got on ESG for the group, and happy to take any questions.
I have a question. On one of your analysis points is analysis viewed as a potential alpha source and or risk mitigation tool. Could you explain that a little?
Yeah, so I think, Bert, right, the way that we've tried to approach it and tackle this with the managers is when they're out doing their ESG work, are they doing that work through the lens of, we're going to identify good operators, right? And folks and management teams and companies that are using ESG as a competitive tool, right? And a competitive tool that ultimately we expect to bleed through in terms of outsized returns versus the broad markets. Think of like an energy company, right? Maybe that's a particularly good environmental actor, and they consciously are building that into their strategy as a management team, and think over time that it'll be a source of incremental return versus the broad category, right? So there's that lens that we look at it through, and then conversely, right? Obviously, the other way to think of it is just from a risk mitigation standpoint. Are we taking actions as a management team along the ESG line to just not expose ourselves unnecessarily, right, to potential loss? So think of maybe the inverse of an energy company, right, that's just not being conscious of the environment, for example, and are kind of treating the topic that way. So that's, I think, the way to kind of think of that. And you see there, right, most of the managers are kind of viewing it through one of those lenses here. I don't know under the hood. I could maybe find out for you across that line item, right, how many are kind of alpha versus risk mitigation. I think it's a little bit of a mix, but that's kind of, I think, the way to think about that category, if it makes sense.
So broadly speaking, it would mean that in almost every one of these funds, they see some investment advantage to ESG consideration.
That's exactly right. Yep. That's probably a more succinct way to put it.
Thanks.
All right. So again, if there's no other questions there, I do want to be sensitive to the rest of the agenda, of course, and we can always come back to this. Tyler, do you want me to, or I guess through the chairman, if you're ready to move on, you want me to control the deck, or do you want me to get out of your hair so you can do it?
Either one works.
All right. Well, if you want to direct me to pages, I'm happy to do it.
Perfect. Just wanted to confirm we're all set to move forward.
Yeah, Tyler, I think, like Chris said earlier, it's a collaborative group. If people have anything on their mind, even if we have to go back, then, I feel like people will do that. So we can move on for now. Thanks.
Perfect. Well, good morning, everyone. Happy Monday. I'm going to go through the defined contribution deck. Just to note, the third quarter is what we call our sort of participant focused quarter. It's always really about the participant, but this is when we can take a deeper dive into the design of the retirement programs, talk a little bit about what you're looking for from an education standpoint, or participant engagement, and then what we also did as a record keeper service update. You have Mission Square, right, the old ICMA RC, as a record keeper. What we're able to do is take a deeper dive into cybersecurity, given how important that has been. And what we did on your behalf is actually send a questionnaire following the DOL's guidance around what plan fiduciary should be asking record keepers around cybersecurity. We actually sent it out to the 21 plus different record keepers that we work with, and got responses. And again, don't have any significant concerns with those responses around cybersecurity. So, Chris, if you want to go to, actually, you can go to the next page. And what I'll preface this. What I think would be good to do at some point is actually have, if the committee would be willing to allow for this, but have the folks, or at least one person from the ICMARC to talk, or excuse me, Mission Square, to go through some of the demographic information, and maybe through that glean a little bit around what we should be doing from an education standpoint. But I did include some plan design benchmarking, again, because you have multiple plans as opposed to one, say 401k plan or 403b. You have the 457, which is obviously supplemental contributions, as well as the 401 the 401 plan, which is again where the money associated with the employer contribution works. But again, this is where people can contribute additional dollars. You have and so this allows, gives you some benchmarking around other like plans. What are the typical number of investment options? How often is brokerage window offered? So again, a window into allowing someone to get access to any of the thousands of mutual funds that be available. And you can see that's not typically in plans, and obviously not offered through this plan. But it also gives you an idea around offering Roth as an option, offering loans as an option. And again, what we're also seeing is more and more plans offering what's called auto features, which would allow for someone to have to opt out of the plan versus opt into the retirement plan. But typically in the municipal space, I find that shifting to a sort of automatic feature may require some discussions from a bargaining standpoint. So no recommendations from a plan design standpoint. I will pause here really quickly to give you a heads up around, and I don't think I did this during our previous meeting, but there has been some talk in Capitol Hill, and I was actually in the Washington, D.C. area about a month and a half or so ago, having conversations around what may change around the retirement industry. And so the Senate right now has two bills that they're looking at with respect to what's called the Secure Act, and how that will impact plans like a 457 plan or the 401a plan are still yet to be determined. But we're pretty confident that the Capitol Hill will come out close to the end of the year with some changes to the pretty sweeping changes to the retirement industry. And again, I'll talk a little bit about it on this page, because it wouldn't necessarily impact plan design. But a couple things that we're hearing will most likely get passed. Again, the timing is up in the air, but right now, folks have to take their minimum required distribution. And previously, if you remember, it was at 70 and a half. So when someone turned 70 and a half, they'd have to take out contributions. It changed to 72. The newest bill, Secure Act 2.0, would have that going to 75. And that's across the industry, right? 401ks, 403bs, and 457s. So the likelihood, the Senate has it going right to 75. The House bill that was passed a little while back has sort of a step up provision, but the likelihood is 75 will be the minimum required distribution. The other bigger sort of sweeping change to the industry is so right now someone can contribute as a core contribution for 2023 $22,500 of their own dollars. They can contribute 22,500. That's a step up from the 2021, should be 2022 number. If you're older than 50, you can contribute an additional 7,500. The likelihood is that's going to be required Roth contribution, and that's a bigger impact to the industry, both administratively as well as I think a lot of folks will need to be educated that. But that's one of the provisions that we keep hearing is going to be mandatory. And I don't know, again, how many people hit these limits within the structure or the of the 457 plan. But obviously, if they do, those added dollars that the government allows for folks to contribute would have to be an after-tax contribution. And why we think that will pass is obviously this is a revenue impact for the federal government, and so we do expect that probably to go through. When this will be required, if it's January 1st, 2023, or if we get some time to figure out this administratively, is yet to be determined. They're also looking to bump up catch-up contributions for 3 ages, 62, 63, and 64. So again, that catch-up's for about 7,500. They're looking to bump that up to 10,000. So more to come on this. I'll pause to see if there's any questions around security. There's actually a lot more in that. Those sort of 3-4 points were the most impactful, but happy to address anything else. Again, nothing you need to do now. It's just sort of my crystal ball, so to speak, around what we think will be passed by the Senate by the end of the year.
Tyler, what's the current age lower limit in order to be able to contribute that additional catch up? Is it 50 or?
It's 50. Oh, sorry. Yeah, you have to be 50 to get that catch up contribution.
Okay. All right. And so they're not considering lowering that age to, you see a little bit of a windfall there for, the additional contribution. I'm surprised they didn't lower the age, but 50 seems logical. I know it really came out of the GFC, right? The ability to kind of catch up and, or at least bolster retirement accounts.
Now, I will say, Derek, it's a little short-sighted. I don't know why. A Roth is great. I think a great option. And again, just a reminder, Roth is that after-tax contribution where you pay the taxes now and you don't pay the taxes down the road. I don't know if it makes as much sense for folks that are in their 60s, right, for catch-up. So forcing folks to make a Roth contribution for that catch-up amount. Again, the idea around Roth is that it grows over time, and then you take it out tax-free. So for a younger individual, it may make a lot of sense for a 62, 63-year-old to put 2 years of Roth money into a retirement account. Doesn't necessarily make sense, but again, I think the federal government sees this as a revenue grab to a certain extent, and so converting all monies that are above and beyond that limit to after tax would obviously be a revenue amount.
And are they subject to the minimum withdrawal? Yeah. Okay.
Yeah, so they're not, and those income levels wouldn't be within a group plan like this. You're not subject to the income levels you would outside of a retirement plan for Roth IRAs.
Gotcha. Okay, thanks.
Yeah. So again, no big changes on this page or the next. Again, you have the 401(a) or even actually the next page. I'll have you go to 53, Chris, just to make sure everyone's aware of what we do behind the scenes. So back in April last year, the DOL did provide some guide. Given there was so much scrutiny around cybersecurity, the industry was really looking for some guidance on what plan fiduciaries should be looking at with respect to cybersecurity. And so the DOL did provide some best practice on what a record keeper should be doing, but B, what you should be asking of those record keepers with respect to cybersecurity. I won't, Chris. Well, I guess you could, since of course you were jumping around. I'll have you go to 71 really quickly, Chris. We provided a questionnaire to Mission Square around all things cybersecurity that does comply with the DOL's best practices review. And so the questions that we asked, and we asked this of all the record keeper partners that we have, the Fidelities, the Schwabs, the Empowers, the Voyas of the world, with respect to, again, cybersecurity. It's what types of training programs are set in place? How are these programs documented? How are they audited? From a practice standpoint, do you have multi-factor authentication? Were there any breaches throughout the year that the committee should be aware of? Are there any insurance that's been set up with respect to those breaches, third-party audits, et cetera? All of that information, and I will not have Chris scroll through, but we have about a 13-page deck here. Again, we aren't cybersecurity experts, but we can also look at outliers and have concerns around those outliers. So, for instance, if Mission Square didn't have multi-factor authentication set up, or if they didn't have any insurance with respect to their cybersecurity, or they didn't have a third-party audit that reviewed that cybersecurity, we'd be more concerned. There were no outliers here that we were concerned with, but we're happy to coordinate if you have an internal IT team, or if you have something you're rolling out with third parties within the town to review sort of personal identifiable information protection or data protection. We're happy to coordinate that. So again, without going through all of the pages, just want to let you know that this is here for review. Again, it does comply with the DOL's best practices, but again, we have no concerns around the responses of the questionnaire that we sent. The last page around and I'll have you jump, Chris, to 54. And I guess this is for the town employees. Engagement's very important. There's really 3 levels of engagement, and again, this is participant engagement. Outside of just offering the plan and offering investment options, there's 3 types of ways to engage a participant. It's a sort of general education, sort of group meetings. Here's the details of the plan, but we won't get the specific around you as an individual. Advice is, here's the specifics around the plan, and here's what makes sense for you as a participant, as an individual. And then the third layer of engagement is more hand-holding, more white glove services around managed accounts. There's no managed accounts that are offered through the plan. Typically, that's an added cost, but there is ways for participants to receive both education around the plan as well as specific advice around what they're particularly doing with their investments. Again, the question to the town employees is, with respect to Mission Square, are they providing enough resources for you around education? Are employees asking for more? If so, we're happy to push back or push to Mission Square to see if we can find additional resources. But I guess I'll pause there. Has there been any inquiries around further employee engagement with the participant base?
I don't know, not to my knowledge, but Tyler, I would maybe just from the town side ask Amy if she's heard anything from Maria or other groups about interest in learning more.
Yeah, happy to take it offline and engage a little bit more around what services they're providing, and if employees, especially in a time of market volatility, are getting the resources that they need to asset allocate appropriately. So
yeah, I mean, what comes to mind for me, Tyler, is that I know the town side is working on upgraded cybersecurity systems, whether that's fully in place already or not, and I'm sure it comes with its own consultation and education, but it might be worthwhile, as long as it wasn't an additional cost, to have them maybe just take a look at our best practices on what we're either in the process of or have recently implemented.
Yeah, and again, no, just to get the folks, the right folks at Mission Square on the horn, there'd be no cost there. I just don't know the cost on on who you're working with, but yeah, there wouldn't be a cost for me to coordinate that. So let us know if that's something you're looking to do. I'm happy to do it.
Okay.
With larger clients.
Thank you.
Question?
Yeah.
First of all, thank you for that. Tyler, if we were to ask you to fill out the same form for your organization, how would you be up to the standards you expect of our vendors? I'm just assuming the answer is yes, but I thought I'd ask.
We believe very much that we do have that level and have been very, very strict around our cybersecurity practices. That being said, it's a little different given we don't hold
Right.
participant data, right? So a lot of the data we hold is somewhat, I say somewhat public, but the assets per all of these things typically need to be filed, and so a lot of the data that we have is public information, but happy to provide information around our cybersecurity controls as well.
And Tyler, for other municipalities you deal with, are you seeing them benchmark themselves against the same sort of Department of Labor standards? Is that becoming industry standard at this point?
We do. So a majority of the client, all of the clients I work with, follow. You are not an ERISA plan.
I know,
because
right.
you're the government plan, but follow the guidelines per ERISA. They find that the DOL has provided some pretty good sort of guideposts around what a fiduciary should do, and so the clients I work with have taken that practice, even though you don't want to declare yourself an ERISA plan because it adds a whole host of potential liabilities, but following the guidelines, I think, is best practice.
And they do the cyber benchmarking as part of their retirement review as well.
Correct. Yeah.
Okay. Thank you.
We provide this for all of our clients, and again, the questionnaire is pretty thorough, and we want to be able to, the fiduciaries. I mean, this committee would be potentially on the hook if there was ever a breach by, say, or at Mission Square. Someone's going to say, hey, they were selected. What did you do, or what did you ask around their cyber controls? And the last thing you want to say is, we didn't ask anything. We want to be able to say we reviewed this every year and we're comfortable with the responses. Now, I can't, and even if we had a conversation with the Mission Square folks today, no one can guarantee full protection of data. And again, a lot of identifiable information's held at Mission Square. So again, no one can guarantee. What we can guarantee is that we ask the right questions and we're comfortable with those responses.
And Tyler, those same questions would be appropriate to ask ourselves as well, because we do contain lots of data as a municipal organization. Is that
absolutely to a certain extent? Again, there's some questions around cybersecurity, insurance. There's some questions around making participants whole if there was ever a breach. Those aren't necessarily questions that would be applicable to the town. But there's three important parts of cybersecurity. It's Mission Square and their ability to keep data safe. It's obviously the town's responsibility on how that data gets there, and it's the employee's responsibility to set up the right controls to help protect their data. What I mean by that is, Mission Square can offer multi-factor authentication, but it's only as good as how you set it up.
correct?
And so often the breaches come from neglect on the participant side. For example, a phishing email comes to an employee that appears to be from Mission Square, but obviously is from a fraudulent individual, and that person provides all of their identifiable information so that someone else can again use that and request distributions and other things. So it's around obviously asking the questions here, but also educating, I think, employees around further protecting their information. The challenge, and I've said this comment before in other meetings, my wife will know if I went to Dunkin' Donuts in Simsbury, maybe this morning, but it may take 6 months before someone knows the largest pool of assets that they have, retirement pool, was fully breached. So it's one of those things that isn't reviewed as much. And so the more we can educate employees, and I can coordinate this with Mission Square as well, the more we ask around and are comfortable with the controls that Mission Square has, but also educate employees around, being more proactive around their data at Mission Square. That help answer your question?
Yes, thank you.
Yeah. So really quickly on page 56, you can see obviously the balances. The themes held true that obviously Chris mentioned. With respect to the markets. So you can obviously see a decrease since the end of the year to the 457 plan, a total of around 13.2 million. Bulk of the assets still in that plus fund, as well as the Fidelity 500 index, and then of course the target date funds, which rounds out the third highest investment. What I'm also looking for here is, if people are moving significantly in or out of different asset classes. So for instance, if people are moving lots of money towards the Vantage Trust Plus fund, maybe potentially timing the market and capturing potential loss in the equities and fixed income space, which is not something I'm seeing here. Plan assets have been or remained fairly consistent across the board, with some of the newer funds less held. If you look at the next page, it's the Board of Ed plan, and then the 401A on page 58. The allocation clearly on page 58 there, a bulk of the assets in target date funds, because obviously this is the newer plan and people are defaulting towards the that default investment option through T. Rowe Price. On page 59, just a reminder of how the target date funds work. We spent a little bit more time last quarter around the target date funds. The lead portfolio manager is Wyatt Lee. We've had a conversation with him about a month or so ago around the different types of plan products they're going to add to the retirement funds, like income driving products, like managed account like tools. And so again, a lot of this is preliminary, but we can have a conversation when this does get rolled out over the next year and a half or so. On to the next page, just a high level overview of the performance. Some noise on the year-to-date side with respect to some of the growth mutual funds through T. Rowe Price have struggled over the last year. Slight higher in international equities, and high yield weighed a little bit on the short-term performance, but as you can see, longer term across each vintage, top decile performance. And in line with or over the index over the longer term. So again, absolute performance is a challenge. Relative performance, more longer term, has been very good. So we do have all those T. Rowe Price funds on maintain. If you go to 62, again, a couple of these funds, Chris has on the pension side. So no concerns on Western Asset. Again, longer term, still performing well. Some more noise on the shorter term side, on the left side of things. And then on page 63 and 64, all the funds that you have on the core menu are currently on maintain, and so we don't recommend any changes to the defined contribution investment options. I'll pause there to see if there's any questions or comments around anything I talked about, the Secure Act, core investments. Great. Well, that's all I had for this morning.
Great. Thanks, Tyler and Chris. I did miss something at the beginning of the. Can you turn that off, please? Yeah, thanks. So yeah, thanks again, Fusion. I think what we have to do is vote on the, get my screen up here to the right one. We do have to approve the meeting dates for next year. Currently, they are February 7th, May 2nd, September 5th, and December 5th, unless anyone knows of these dates being on any holidays or a date we otherwise couldn't hold the meeting. I think we're probably okay in approving those dates, and we'll continue to hold them the first Tuesday at 8 a.m. I know it's been Mondays more recently, but we're going to move that to Tuesdays. Any discussion there, any interest in moving those dates or keeping them? I'll accept the motion to just approve the dates as presented.
So moved.
Second.
Thank you. All in favor?
Aye.
Hey,
Great. And then that looks like it's it for the day. Appreciate everybody's confidence in me for another 4 meetings. I hope everybody has a great holiday if we don't talk. And thanks again to Fiducian for their diligent work and communication. So thank you all.